Michael Saylor has 818,334 Bitcoin. He also stated earning a BTC yield of 9.6% year to date. The market is calling this a win. However, I think the market is looking at the wrong number. This is the Bitcoin Weekly by Blockrise. Here's what actually matters. Start with where we are. Bitcoin is trading at around $77,000. That's roughly 66,000 euros, up about 2% from last week. That puts us at 6% above the 50-day average, which sits around 62,000. For the first time in months, the price is above the short-term trend. The 200-day average is still higher at around 72,500, so Bitcoin is below its longer-term trend. The gap is narrowing, but we are not there yet. One number worth noting is the fear and greed at 33. That is fear. While the price grinds higher, sentiment has not caught up. That gap between the price and the sentiment is where the interesting conversations live. Yesterday, Michael Saylor announced that Strategy had purchased another 3,273 Bitcoin on top of the 34,000 Bitcoin last week. The company has spent roughly $62 billion building this position, averaging around $75,000 per coin. Saylor had called a 9.6% Bitcoin yield year to date. That is the number that went viral on X, over 16,500 likes. The market absolutely loved it. But here's the number problem. BTC Yield, as Strategy defines it, is the percentage change in Bitcoin held, minus the dilution from share issuance, divided by the starting Bitcoin position. The idea is that if you issue equity at a premium NAV and use the proceeds to buy Bitcoin, you end up with more Bitcoin per share. And that is technically true. But let me ask you the question that the headlines actually skipped. Where is the yield coming from? It is coming from issuing new Strategy shares, diluting the existing shareholders, and using the proceeds to buy more Bitcoin. Every dollar of BTC yield is a dollar of equity dilution. The yield is not free. It is not operational. It's not mining rewards or fee income. It is balance sheet arbitrage funded by shareholders who are betting that the Bitcoin goes up faster than the dilution compounds. Now, is that a bad bet? History suggests it has worked so far. Strategy has made enormous paper gains on its Bitcoin position, but the yield framing obscures the risk. When the Bitcoin price stops compounding, the dilution dynamic inverts. More shares outstanding means the debt per coin gets heavier. The model depends entirely on the continued Bitcoin appreciation. I'm bullish on Bitcoin, but relying on such a strategy remains risky. On top of that, here's the question I keep coming back to as someone who has been in the space for a long time. If you cannot verify the Bitcoin on the network, is it really there? Strategy's Bitcoin is held in wallets that the public can audit, and that is the part that Saylor always gets right. But most institutional Bitcoin exposure right now is in ETFs, in paper Bitcoin, on custodial books, where verification means calling your broker. At most, they settle once a day, meaning that there's still a 24-hour risk window. And that is the real story underneath the BTC Yield headline. The adoption is real, while the infrastructure is still catching up. The most important thing you can do with your Bitcoin is verifying it yourself. And that is the step most people still skip. Then, most people miss this. Bitcoin just closed above its 21-week moving average for the first time since October 2025, when the price was trading near $115,000. That is 5 months of price action, condensed in a single week candle close. And the history of Bitcoin reclaiming the 21-week moving average is worth knowing. The last time Bitcoin did this, reclaiming the 21-week moving average after a cycle low rejection, was in early 2023. Before that, mid-2020, right before the pre-halving rally. In both cases, the reclaim has preceded a significant move higher, not immediate, but within weeks to months. This time, Bitcoin has been below the 21-week moving average since late 2025. The reclaim is recent, but it needs to hold. A weekly close below $75,000 from here would invalidate it. But if it holds and the macroeconomic backdrop cooperates, this is the technical setup that people who have been watching the weekly charts for years consider meaningful. However, one caveat, this is not a prediction, it is a setup. The data says the probability of a response has been historically positive. The market has yet to agree. I will watch this level. Two things for the next 2 weeks. First, whether Bitcoin reclaims $80,000 and is able to hold it. 4 times in the last 2 weeks, Bitcoin has hit the high of $79,000, has been rejected. There's a cluster of short positions, roughly 1.4 billion in shorts, at the risk of liquidation above 80,000. If that level breaks on real volume, the squeeze could be fast and sharp. The longs funding those shorts will be forced buyers. This is the setup, not a guarantee, but it's worth watching. And second is the ETF inflow streak. 4 consecutive weeks of net inflows now. Bitcoin ETF AUM is at its highest level since February, and that is institutional demand showing up in the data. When ETF inflows are slow, that is the signal to pay attention to, not the price action, but the flow reversal. Concluding, the adoption story is real, the self-custody story is the one that matters most. This is not financial advice, it's just my perspective on what's happening based on 10 years of building in the space. Do your own research. See you in 2 weeks and verify your Bitcoin.